Hey everyone, welcome to our biweekly market talk. Oh, what a day it was in the market. Puts are printing, at least for now. So I think today we will discuss if we expect this bearish move to continue or if we are still in a chop. So yeah, I hope you will enjoy our talk and let's start. So Bryan, how was this day? What do you see in the markets, and what are your views for the future?
Yep, sure. Sorry I missed last week, y'all. I was taking care of some personal things, but broadly, I really haven't been doing that much in the market. Haven't really been trading through this chop at all. I've been just pretty much avoiding it because it's really been now over a month and a half since I haven't had really any signals that say that we're gonna have any kind of sustainable drop in stocks. So I'll share my screen here and we'll get right into it. So let me start over here. So S&P, we were talking, like looking back a month ago, we were talking about how correlations were weakening really aggressively out of the banking crisis. And then the thing that actually caused everyone to buy protection was the catalyst for the squeeze in the end. So we squeezed up completely, completely avoided it. I degrossed pretty much all of my shorts down here, and I lost absolutely nothing in this BMR, which was awesome. And so now I'm just in the position of trying to figure out when the best time to get back in aggressively is. One thing we saw over the last 2 weeks since the last meeting was S&P IV ranks. So the way I look at implied vol is just simply IV rank. So it just looks over the past year. Scale of 0 is the lowest IV at the money, 100 is the highest IV, and where you are within that range. Throughout this entire move, I got no signals that told me to short at all. Like no correlations got to extremes. Trend skews were pointing higher. Hurst exponents were going higher. The gamma setup was all positive. So I didn't have anything to tell me to short, but the one thing I did have at the time was a 0% IV rank on SPY. And so that came right around here, right alongside Raphael's sell signals. So the 14th to the 18th, we had 3 days there of just really cheap vol. And so I opened up 2 sizings to puts. So for like 1 of 3 sizings, I went to S&P puts, SPY, and my strategy is I buy 1 set of contracts of near-term downside and 1 set of contracts at the long-term downside. The near-term ones were for the June quarterly OPEX, and the long-term ones are for the September quarterly OPEX. That's just kind of the way I did it after going through the puts back in February. I thought that'd be a good strategy to try this time around. So I did 1 size in at wherever those ranges were at that time, and then I did a 2nd size in at that time. And those have really been my only big plays at this point over the past 2 weeks. And the puts are working, but I don't think they're ready to really work yet. I mean, where we're at now is so over the course of the last week, for sure, we've seen the long-term and the near-term range on SPY and MFR drop aggressively, especially the long-term. I want to say earlier last week, it was up at 438, something like that, was the top of the long-term range. It's just been dropping and dropping and dropping through this chop. So we've started doing the chop, we started going lower, and it's dropping aggressively. It hasn't given me that signal of being capped, so where the near term and the long term range is the same, but it's been dropping aggressively, and that's also come alongside a lot of other very limited excess long term upside in things like XLU, for example, which is something I'm really interested in shorting right now. This is one that shows very limited excess long term down upside versus the long term downside. So that's a very positive trend skew. We had it that way earlier this week. XLE, before it started selling, that one showed a very limited amount of upside. It's actually started improving here recently, so less of a good short now. XLP, and you see the theme I'm sticking with right now. It's all defensives. Like what we've seen is they've just chased defensives so hard. Everyone is pricing in deflation. Consensus is completely chasing deflation. This move on XLV, for example, was a big signal of that. And so I would definitely not be long the typical deflation longs right now. And those are the ones I'm looking to short the most whenever I get a chance to. And kind of what I'm looking for when it'd be a good time to short is going to be first correlations. So throughout this entire move, the number one thing that's keeping me away at this point is stock bond correlations just being still negative. They were extremely negative the last 2 days. They actually started going a little positive today. So maybe that's a trend that we get in the GDP number tomorrow, that they start trending positive. So maybe that comes on a light GDP print is actually good news for the markets. I'm not quite sure at this point what's good or bad news, because you have this confluence of stock bond correlations are negative, but dollar stock correlations are negative as well. And then also sector correlations have softened as defenses got whacked today and tech going up. So it's like the big problem of why it's like not the time I can just be so aggressively slamming the short button right now is because this market's completely uncorrelated. It's like one day you got defensive leading to the upside. The next day, Russell's leading to the upside. Today, NASDAQ closed green against Russell getting smacked. It's like you can't even really pick what's going to work on like a trending basis. And when you get that kind of action, it's unlikely for us to get some sort of sustained breakdown, especially when you get people just start chasing it puts aggressively. So throughout the last 2-day move, especially into earnings yesterday, and then we even saw it follow through today, they started chasing SPY 405s and SPY 400 puts really aggressively. And so like 405 is actually the put wall right now and the absolute gamma strike. That's what's caused obviously the big bid and vol we've seen over the last 2 days. Not really that impressive, but a bit of a bounce in VIX for sure. And the problem there is that since correlation risk isn't very high and you have put wall at 405 and then 400 is really strong just behind it, if you recapture 405 out of GDP tomorrow, you get a huge vol crush, and this thing just absolutely moons. And the near-term ranges for an MFR aren't favorable, so they say that's possible. Like the near-term range doesn't even go to 400, and we're not capped to the upside, so I can't confidently say that we're not going to go back into the 415s, the 420s again to the upside. And so you have that, and then in conjunction with my like net exposure model here, which looks at all the factors I load in from MFR and tracks their ranges and their trends, that's been firmly positive on all of these dips lower. So it's like the trend skews are not that favorable right now. They're getting better. Like the long-term ranges are dropping, which tells me that top is probably near, or maybe we've seen it already, but it's not telling me to be aggressively short right now because I see the trend skews dropping. I'm not interested really in playing the long side in like an aggressive way, kind of like how I did back from March and like really trying to go long during that. I'm just waiting right now. And then the last point we saw was Hearst exponents. So they were strong earlier in last week and towards the beginning of this week, but the last 2 days, they've just dropped really aggressively on this down move. So Hearst are pretty light now. So if we look at like SPY, like these have now dropped under 0.70 almost, and maybe they'll drop again tonight. Fixed income and gold are still a little stronger, but equity Hearsts are dropping on this down move. So that's not a good sign for continuation lower. The gamma setup says you get a big squeeze to the upside and correlations aren't high to say that there's a big breakdown. And now the trend skews kind of flipped neutral from a downside trend skew we had earlier in the week. So there's really nothing here that would have me pressing shorts today. There's actually nothing there having me press shorts yesterday. So I didn't really capture much downside, much upside in the portfolio on this 2-day down move here. The only thing that really worked for me was short gold for today, and then long those puts worked well. But I would actually prefer those puts to lose the gains I just had because I want to get up some more sizing both on SPY and QQQ. I just have 2 sizings on SPY and 1 on QQQ right now. So I'd like to get more on there. I don't see anything that says the thing is just going to absolutely collapse on tomorrow's GDP number. So maybe we dip, maybe we rip directly, but I don't think 400 breaks. And I think we're probably above 405 by the end of the week. And maybe if we're above 405 out of tomorrow's number, we probably rip into month end, maybe even into FOMC. So we'll see. But that's where I'm at. Nothing really to short at all.
I agree, and I'm also in the same camp. I think you saw my tweet. I also have some June puts, which is not very common for me to have directional bets, but when volatility was so low, I think you agree. We don't know where volatility will go, but when it's so low compared to the cycle, I mean, it was just crazy not to buy puts, in my opinion. So I bought some.
Yeah. It's like where you're at. What I was looking at there is like I didn't have any signals telling me to short, but I'm really happy over the last 2 days that I was long those puts. So it's like a way, like, okay, I'm going to buy these vols that are cheap. Eventually, if I go longer dated enough, they're going to work. And then they might work on a day when I don't expect, and then I'm happy that I have them. So it's like a nice little hedge to have, even though like it's not really telling me to like go big and I think they're going to work right away, but there's something you can just put on opposite some other positions like long dollar, short gold, short bonds that can kind of hedge you a little bit, especially when stock bond correlations are negative.
Yeah, totally. Okay, Ted, let's continue with you. So what's going on in the markets? What you see and what you think?
What is going on? Apparently Meta just reported and busted another move along with Microsoft. So we got that going for us. But let me sort of share my screen and give you a sense of where I am. I'll do a short presentation here. I know we've got a number of guys on, so I'll try to keep it tight. As you know, I like to invest with or have a good sense with where we are from a macro regime point of view. So I'll take a look at where we are there. Hopefully Christopher can give us some insight into that as well. Looking at some market signals and then positioning as a result. And I can tell you in advance that I'm still heavy cash and sitting on the sidelines and eating popcorn. So what's going on from a growth point of view? So basically it's a mixed picture from my perspective. We talked about last time did we have the return of Goldilocks with inflation down and growth up? It's really sort of a mixed signal. Flash PMIs came out last week. They were up slightly in April. Manufacturing 50.4, services 53.7. Again, slight moves, but really just settling around a mean, up and down month to month. Retail sales seem to be slowing pretty consistently on a month to month basis. Retail sales are reported prior to inflation, so we've got a retail sales is not keeping up with the CPI headline. So really a decline in retail sales. Yet last month we had a big pop in new home sales in the States, so plus 9.6% month over month. But if you look at the chart, it's up and down each month. As interest rates go up, prices, home sales come down, and vice versa. So, and then what we've seen is from more of a leading indicator, we've seen jobless claims continue to tick up. They reported 245,000 claims last week. And so we've got a little bit of slowing in terms of the overall employment picture potentially. And then, of course, as Bryan mentioned, Q1 GDP is going to be released tomorrow. Conference Board, which is puts out a summary of leading economic indicators for the United States, reported LEI was down 4.5% over the 6-month period between September 22nd and March 23rd. That was an acceleration over the previous 3-month period, and they're definitely forecasting a recession. Likewise, Fed minutes from March came out this past week, and Fed officials, and this Fed officials being staff from the Federal Reserve, expect gross domestic product growth of just 0.4%. So we looked at the Atlanta Fed last time we were on; they were tracking plus 2.5%. So that would indicate a pretty significant pullback in the latter half of the year. A lot of the macro sort of services that we may subscribe to also are kind of showing this decline in growth. Inflation slowed for a 9th consecutive period to plus 5% year over year in March. PPI was also a surprise number down, a deceleration, plus 2.7% from 4.9%. That's the lowest since January of 2021. We've got both PCE on Friday. It's expected forecast by the Cleveland Fed, which puts out a good measure every month, plus 4.58%. And then we also have the employment cost index for Q1 coming out on Friday. That's a measure of total wages plus benefits. That's projected at 0.8%. quarter over quarter, so annualized would be 3.2%. So here's the problem. The New York Fed put out a survey last week, and this is their summary of consumer expectations. And what's starting to happen is inflation expectations are becoming somewhat unanchored. So they increased at both the 1 and the 3 year ahead zones to 4.7% and 2.8%. I'm sure that 4.7% number is cause for concern among the New York Fed. Additionally, credit access perceptions deteriorated, households reporting that it's harder to obtain credit than it was a year ago. Not surprising given the banking crisis. So my view is we're moving towards a deflationary regime. We'll see how that pans out. So what we've got, from my view, is we've got the Fed hiking into a probable recession. They come out on May 3rd, next week, Wednesday, plus 25 basis points, pretty much baked in. That'll bring Fed funds up to 5.25. QT is expected to continue unabated. And then do we have a pause from there? Somewhat unclear with inflation expectations rising. That is a problem. It will be really contingent upon what happens with PCE on Friday, as well as the employment cost index, to give us a sense of what the Fed's going to do from here. Also, the banking crisis from March, which seems to be a distant memory, although yesterday with First Republic reporting and their stock down 50% in a couple of days, it's clear that the results of that have not sort of manifested all the way through the economy. So as a result, we've got tighter credit conditions manifesting as banks continue to basically hemorrhage off their balance sheet. Not so much operating, but their balance sheets are contracting. So that means less lending, less availability of credit for consumers and businesses. Also, we have fund debt ceiling looming. That's creating some uncertainty and some wildness in the bond market with we had 175 basis points steepening between the 1 month and the 3 month. And then on the back end, we've got this epic 10-year, 3-month treasury just inverting massively, which has always preceded a recession. So from my view, we've got a recession baking in, we've got a Fed baking in, hiking into that recession, and trouble ahead. From a signaling perspective, I use something on a weekly basis just to give a sense of what's going on in the market. I really like Williams percent R in certain situations. But what we saw coming into the end of last week, we saw really SPX pinned into OPEX. It was unable to crest the 41.55 and was setting up for a potential double top on the chart. And so that 41.55 level was pretty solid. It might have got up a little bit beyond that, but that was the 50% retracement level off the low from last October. It's really had a tough time getting through that level. We also, as everybody's alluded to, we saw VIX and other VIX 16 last week, other measures of vol at 1-year lows. But at the same time, we've got SPX and Qs diverging from small caps, with SPX and Qs showing relative strength, small caps starting to deteriorate. And on my models, it's in a bear trend, while SPX and Qs, at least through yesterday, were still bullish on a 3-month momentum basis. Also, we've got hedge funds epically short the 10-year. At least according to a report I read. I don't have the CBOE information, but that's a report that I read. And we got this interest rate volatility starting to move again, with the move back up to 137 from down to as low as 116, I think, within a week. And then my weekly signals, some of my weekly signals flashed risk off as the OPEX pin was removed. So what I saw was a sell in the Shanghai Composite Index, which has sort of been our growth leader, if you will, worldwide. So I look at Williams percent R when it gets up above the 20 level or the -20 level. I also looking at where it is in relation to Bollinger Bands and Fibonacci levels, and you can see that the Shanghai Composite, basically bumped right up against the top of its range and then sold off. So this is a pretty strong signal, and we have seen follow through on that this week. I tend to look at this on Thursday so I can position on Thursday for the following, or on Friday for the following week. Also got a sell in gold last week, which led me to sort of, I've been covering my gold position in my all-weather account, and I basically have closed that out to about less than 50 basis points at this point on the long side. We also got a pretty strong sell level in crude last week, and that we've seen follow through again today. It kind of bounced around earlier in the week, but today we got 3.5% down on crude. So that's sort of following through. Had a Bitcoin sell signal as well. That's my favorite risk indicator. It really kind of tracks tech in a way, and that has bounced back, but it's under pressure again now. So we'll see how that kind of pans out. But again, this was something that was up at the top of the range, was overbought, and due for a pullback. And then I've been watching nat gas for a long time. I like to position in it every now and again. I position really small because I've gotten burned like everybody, the Widowmaker. But basically, I've been watching it for a long time. We've had this sort of divergence in the Williams percent R. We had a positive signal in it. We got a good bounce in it. It's off today. I'm slightly underwater on a very small position, but I'm continuing to average into it because I think we're near a low. And then I got a really tepid buy in the US dollar. It sort of rose up. It's very oversold down around the low end of the range. So I did start adding to dollar UUP in particular on this move, but not terribly aggressively. And you'll see from my positioning, I still remain heavy duty cash, 87% between bills and cash. Got a 3% UUP position. I did have a 3% RWM position, which is short IWM. That I took down yesterday as it started to sell, and I actually sold some more today. CTA I hold as a constant. It's a good negatively correlated asset to most risk assets, so I hold on to it. It's anyway, I have it. I've added in the last week, I added IVOL interest rate volatility, not enough of a position. It ran on me, so I couldn't get bigger in it. I did take off my TBT position, which I was hedging against TLT, just holding TLT, and also shorting high yield bonds that I added to yesterday, and I'm planning to build that position up. I think high yield goes down hard at some point here. VIXM I had up to a 3% position. I took some of that down yesterday, and I'm still hanging on to, I don't know why, Mexico. I added a small position in UNG, and Momentum I shorted last week, and it finally started to work for me today, actually. So I'm still hanging on to that position for now. Well, that's what I got, guys.
Yeah, maybe today we will receive an answer from, for example, Christopher. So when it will be a time to short the euro, because I have some that I tried to find a spot to add to my position, and yesterday it looked that maybe today will be promising, but as we saw that no, today was not promising at all. Yeah, so great insights, thanks. So Christopher, let's continue with macro. So maybe you know when to short the euro.
So actually, I don't know. I'm also in the deflation camp. So long dollar would be my main signal here. But giving some technical systems, which I would like to point out later in my new templates. I also got a pretty good bullish signal on Euro USD for the next 10 days. So maybe it takes some time until we see a reversal. But for now, I will share my screen right here. So this is my GDP nowcast for tomorrow. So basically, we're at 0.12% year over year. So it's down. In my opinion, and this is the biggest gap right now I remember, because if I look at my terminal here, then we are seeing that the consensus for year-over-year GDP tomorrow is at 1.6%. So this is a huge gap in my opinion. And even if I look at the Bayesian estimation with 75% confidence, upper confidence interval, we're at 1.44%. So in my opinion, there's, I don't know, based on the macroeconomic risk, there is some decent potential here. But overall, as Bryan pointed out, he sees no risk or currently no positions to entry for short overall. So I don't know what to think of markets currently. So yeah, I just focus on the slow macro stuff. Yeah, so what I actually wanted to talk about is interest rate spreads and recession. So I went through the data again, so you can see the 10-2 spreads is the blue line, and the 10-3 month spread is the red line. So we're at inversion territory again, which often precedes, or basically every time precedes, a recession. And these indicators often incorporate a pretty decent lag. So I tried to quantify this lag, and what you basically see here is a R-squared distribution of several lagging months for the 10-3 month spread for predicting a recession. And what we're basically seeing is that the plus 17 month and plus 18 month forward lag is the best outcome. So the inversion started in last year in April or May, if I remember correctly, for the 10-3 month spread. So there's some time left based on this analysis before we see a recession. And the same can be said about the 10-2 spread. So we're also going to see a plus 17 to 18 month forward lag in these indicators until they give us the best information signal for predicting a recession. And for the 10-2 spread, I have it here, is inversion started basically at early April. So if these indicators prove to be wrong, then Q3 of 2023 is the main, or is the best signal for a recessionary entry. And this is also what a kind of my interest rate recession model points to. So if we look at the red line, is the recession in 6 months. So I forward lag the ECRI data. So we are going to see some decent probability jumps in the current month based on this model forecast. And actually the recession in 12 months is the better outcome. So we are looking at Q3 or early Q3, late Q2 and early Q3 of this year, where we are going to see some decent jumps, in my opinion, in terms of recession probability. So maybe we're getting another good entry for shorting equities there. But until now, recession probability remains pretty low at this current stage. Another point I would like to make is the ISM. So I always like to track a price differential of moving averages for the manufacturing PMI, because it actually mimics the year-over-year returns in the SPY pretty good. So we got a correlation of 0.61, which is decent. And it's also, in my opinion, a great macro momentum tool. So it gets you out in bad times and gets you in if everything is safe, basically, if you back test it. And if we are going to look at the ISM forecast, then we are going to hit the lows in the next 1 to 2 months. And until then, the forward-looking data and also the some of the time series forecast point to a higher ISM data. This is actually pretty decent if we think of ISM as a somewhat leading indicator, or basically or not a leading indicator, but a monthly estimate of GDP. So it can be it's not actually a bullish macroeconomic signal, but it also points to some entering of a recovery stage later this year until we get the bigger recession signals. Maybe this data will adjust, so it's the current forecast So I don't know if things get really complex and really chaotic, so then no forecast will ever work. But this is my current estimate for the ISM. So we will hit the lows, maybe we go on sideways for some months, but the lows will be in next 1 to 2 months, in my opinion, or based on the current data. This was it for the macro stuff, and now I would like to go over some other data for some. Oh, shared the wrong screen. Yeah. Which screen do you see? Is it the? Yeah. All right. Okay. Good.
Yeah.
So what I did in the last weeks was editing a new script, which incorporates 3 main indicators. So it's the Lyapunov exponent, which basically measures exponential moves or diverging trajectories. So it's an exponent from chaos theory, as well rolling Hurst exponents, which the other guys already elaborated on. And another new indicator for me is entropy measures, or Shannon entropy. So it actually measures the distribution of returns and looks at the unpredictability of a current state. And each measure is basically in a rolling estimation. As a rolling estimation, and higher Lyapunov exponents point to more exponential moves in the stock market, which you can pretty much see in 2020. So it's actually what I found out is that these exponents mimic the VIX. So if you look at my Substack, you can see that if you do the Lyapunov exponents on the S&P 500, you could get actually a pretty decent signal for the VIX. So if you want to check this out, I think I have this chart on my Substack. It's a pretty good correlation there. Hurst exponents you already know. So and Shannon entropy is same. The higher the Shannon entropy, the more unpredictable a current stock price, or basically return distribution becomes. So it's also a signal for chaos. So I put all of these together in this forward prediction model here. So you can see forward returns, 10-day forward returns predicted into 5 quantiles. Each quantile is color coded. So you see red is a good buy signal, blue is a kind of short signal, and the midpoint is an optimizing process for minimal crossovers and maximizing returns. So for the DAX, I currently get a latest quantile measure in Q2. So we're seeing that the mean expected outcome is at minus 0.007, so minus 0.07% over the next 10 days. So it's basically at this point a mean reversion, in my opinion. So nothing here. Like this indicator is currently in a bullish trend, and but not a pretty good sell signal. We should wait until we hit a Q quantile 1 print, which has a really good sell signal and lower expected forward returns. And then we can look at Bitcoin, which printed also a kind of a sell signal right in here in Q2 in second quantile, which has a minus 2.3% over the next 10 days, but it still had a bullish trend, and the R2 for the test set is pretty good in this model. So it's 0.7, which is a pretty decent stat for a machine learning model, in my opinion. So we got some kind of low sell signals here. On the next indicator, we're looking at S&P 500. So quantile 1 print, somewhat mean reversion over the next 10 days. But looking at this indicator, it's bullish trend. and overall we are seeing that some higher entropy measures. So we are still at a pretty unpredictable state. So some zigzag moves or could potentially happen, and it's not a decent signal for another bullish trajectory over the next months, because historically Shannon entropy is pretty high, which always precedes in higher volatility and really unpredictable states. So this is what I wanted to share for today. If you have any questions, feel free to ask.
Yeah, actually, I have one question. Have you ever done your studies for Japan, for example?
For Japan, I will search for the indicators, right, and we'll share them.
Yeah, because why I'm asking, not only I am interested, but we have a couple of clients, and people are sometimes asking about Japan. So Japan is quite a big market, especially if we're talking about financial markets. So this macro data, if you have something, it would be very useful for people, I'm sure.
All right, I will.
Okay, so thanks, Christopher. So Robby, what changed in the markets? What you see, and what are your views?
Hey, Vi. So I wanted to share a single chart today. Altogether, I don't think much has changed on the surface when you're talking about price. Really, we haven't gone anywhere. And that is evident from looking at correlations, as Bryan showed earlier, as well as just, price itself hasn't gone anywhere, and realized volatility is basically on the floor. Can you see my screen right now?
Yes, we can. Yes.
Okay, so this chart is basically looking internally into the S&P 500 and looking at a liquidity measure. A couple weeks ago, or maybe it was a month ago, there's a fellow on here who was talking about order book liquidity in the S&P 500. And so this chart is meant to be a proxy for order book liquidity. It was an indicator invented by a fellow named Yakov Amihud. And all he does to measure liquidity in the S&P 500 is take the absolute price change, or absolute price change return of a stock divided by its dollar volume. What I've done is I've done that for every single stock in the S&P 500, and then I've ranked it on a 50-day basis. And then I've done one more step, which is taking a 10-day moving average of that. So on this left-hand side here, you've got very, very high liquidity. And then on this right-hand side here, you've got, 20/20 illiquidity. What it's saying is normally when it's very illiquid, you're getting huge daily price moves. For example, 20/20, and that would coincide with really high correlations. The past couple weeks are represented by the orange dots. So internally, we've been having wild price changes in single stocks relative to the volume traded, but price on a daily basis has basically gone nowhere. So that is really, really weird to me. And this state basically makes me question whether the short-term correlations are truly representative of what they're going to be in the next couple of weeks, next month, or next 2 months. Now, of course, this is outlier data, so there's nothing statistical to back up my hypothesis, but I do know that illiquidity in general is not a good thing. So that's mainly what has stood out for me in the markets, aside from correlations not really doing anything and prices not really doing anything at all. It's just been terribly illiquid under the surface.
Hey, Robbie, I got a question.
Sure.
So basically this chart says that, I just want to make sure I'm understanding it right. So basically it says, as compared to the volume that you receive on a stock in the day, it's not moving as much as it should on an intraday basis.
So yes and no. So basically, the average stock in the S&P 500 is moving like crazy relative to the amount of volume trading. So that's an illiquid condition. But the index itself, which is this y-axis return, has gone nowhere. So that's these orange dots that are clustered around the zero line. Whereas normally, when it's this illiquid, say past this blue line, you're getting these wild daily changes.
Okay, so you're basically, yeah. So we're getting a lot of movement on the single stock level, but you're gonna have one, like kind of I was talking about earlier with the correlation. So you got tech up big today against utilities down hard, which then equates to S&P not being down very much, kind of thing.
Right, exactly. Yeah. So the correlations are masking this sort of weakness, and it makes me really question whether how sustainable low correlation is going to be in the next month or so. We have recently come off the floor of low correlations on a short-term basis, but they haven't spiked materially by any means.
Yeah, it was interesting. Like we had like one day, I want to say it was last week, towards the end of last week, when I was my first little sign, I started trying to short some things where short-term, like 5-day correlations, I think like 1 or 2 days they spiked up to like 0.8 or so around there, and then they just recently backed off the last 2 days on this down move. So it's like, yeah, it's like bubbly under the surface. I think you get a big move soon, which kind of goes into the theory that like we could be near a top now. Like I think we get, since correlations are still so low, like potentially a big rip higher with correlations like spiking on that move, and then that would lead potentially more movement like this. Because this chart here, like you're showing daily returns both to the upside and to the downside. So it's like, yeah, we're not moving that much at the index level right now, but that doesn't mean we immediately have to move aggressively down. We can move aggressively up too, as possible.
Right. And there is some evidence that suggests it's not a great moment to short. For example, the spread between implied and realized volatility, basically because we didn't really go anywhere in price for so long, VIX just stayed at a high level relative to realized volatility, and it got to probably like 8 plus points today. And for context, at the March bottom, it was 11 points. So what a rip higher would do, potentially, it would spike correlation as well as compress implied volatility and spike realized volatility as well. But that's all theoretical.
Yeah, and like what you could possibly get on a spike like that as well is like vol up, stocks up too. So you could get maybe we don't see IV as low as we did last week. Maybe it doesn't go back to zero, it compresses a little bit. Some of these puts get in, but then you've got an equal chase with calls as well. And so VIX could hold a bid even with it's going to come down a little bit from where it closed today, but it could broadly hold above the lows, and S&P could go back up to 415, 420. So yeah, makes sense.
Right. That would be ideal in terms of a sell setup, I think, and sort of what it sounds like you're looking for.
I hope so. That's how I'd love just a big, huge, just big spike. And then just like the big fat pitch in the short. So I think Raphael is about to tell us that's going to happen. So let's hope.
Yeah. Okay. Well, thanks for letting me present, guys.
Yeah, very interesting. I'm also really interested to see where correlations will be in a month or so, because even after today we had quite an interesting day, but signals have not changed. I mean, it's still basically about nothing. So yeah, we will see. I'm also interested to see that. Okay, you want to add something now, or?
I'm good unless unless you guys have any other questions.
So stop sharing your screen for
Oh,
now.
my mistake. Here we go.
Yeah, correlations are not high, and okay. So Raphael, so what will happen? I was always asking, everyone what's going on, and what you say now. For you, a question is what will happen tomorrow.
Yeah, it's pretty hard to come after all this. I mean, you guys are dropping nuclear bombs after nuclear bombs. It's a lot of very interesting stuff. So, regarding what you gave us, Robby, it's mind blowing. I would say that the missing ingredients is a long-term correlation going towards the direction that we want. For me, for now, it's only theoretical. I will address this when it happens, but I have a theory on why you have this kind of result in your data, and why the missing ingredients is a long-term correlation. But when it happens, and I will call it out, then maybe I can expand on this. So yeah, I will share my screen and tell you what I see. Give me a sec. Okay. Should be this. Okay. Do you see?
Yes.
Okay, good. So 2 weeks ago, so I will go through what I was seeing 2 weeks ago, and basically what happened, and what I think is gonna happen next. So 2 weeks ago, I was saying that we were missing the overbought on matrix, and that was a missing ingredient to get the sell signal. And I highlighted the possibility to have sell signals there. This is basically what happened. I got the sell signals right where I marked them 2 weeks ago, and we started to get the sell from this direction. A lot of clues starting to add up last week that were addressed by Bryan also. The fact that the long-term top of the range started to go down aggressively, and then in the days after, we started to see the top of the normal range also started to go down. So that was very good indication that the market was somehow exhausting itself. So I would say that the sell-off that we are seeing this week was pretty much predictable. The thing that is missing, and it has been addressed by everyone, is the correlations. They are still not here. They are not as powerful as what we have seen in March and in April and in February, and also last year in August. So for now, this is also big ingredient missing. Short-term correlation that we are not seeing building up across sectors. Also, especially, we are not seeing the stock bond correlation short-term doing what it has done before to signal the top. So sure, got the sell, it's selling off. The issue is that we don't have all the ingredients to call for a continuation. Nasdaq 2 weeks ago, so the issue was my matrix indicator was already selling off. So the issue was it going to bounce or go down? It's going down, but the Nasdaq is going nowhere. So also another thing that Bryan indicated, sure, we have some sell-off in the SPX, but we are not seeing this kind of sell-off in Nasdaq. Nasdaq is going nowhere despite the sell. and the matrix is about to exhaust itself. So it's not very good sign for continuation for bears. Europe is going nowhere. I mean, it's a recurring joke. Sure, we got
Back all-time high.
Sorry, yeah. I mean, it's all-time high. I mean, it's a recurring joke. I mean, I got sell signal, but it's doing nothing. Just keep going higher. So I'm just not touching it. I have the position on, but I'm just not touching it, not adding. Deleverage the somewhere here and try to add on the first sell signal, but yeah, it's not working. So it's not there yet. So not addressing this one. Got the sell signal on Nikkei. This one is usually pretty accurate. So had it last week, and yeah, it's starting to go down. I would not be surprised to see Japan somehow correcting. The dollar is a big problem. So in MFR, it's still bearish trend, no change there on the DXY. Bearish, and the upside downside is just crappy. So sure, you can trade it off from the somehow some type of bottom here and maybe get a better average doing some day trading, but for now the trend is just not there on the dollar. This is another reason why the continuation for the sell-off is hard to get. How can you get a sell-off in stocks if the dollar is just going nowhere? So yeah, that's another problem. Yeah, the Euro USD, it's a mirror image of DXY. So yeah, we are not even at the mean for the vola trade of Euro USD. So it's not worth adding, just waiting on the FX positions. The interesting stuff, so for VIX, this is the reason I took the shot on the, I cannot see the date because of the Zoom thing, but yeah, this was the date. I cannot see the date, sorry.
April 19th.
Okay, April 19th. So that was a good day to buy puts. Got the buy signal in VIX. Also the IV rank from Bryan, we are signaling 0% for SPY, so that was a very good call. But the issue is regarding daily vola profile. We are not there. We are not at the spot where we can get some continuation in volatility. So if you follow us, if you follow these videos of Market Talk for a few months, you know that what I'm watching for the start of the big VIX move is trade for VIX volatility to match trend for VIX volatility, and this is the time when the vola of VIX is going to start to crumble, and when the VIX will get the spike up. Okay, so you can see it happened there, it happened there, it happened there, it happened there, and here we are not there. Okay, despite the fact that I got the buy signal on the daily, we are not there yet. So what I would be looking for would be a trade of the vola of VIX to keep rising and to match the trend of the vola of VIX. So I would guess this event would happen somewhere at between the second and third week of May. That would be a very good time to see the real bottom for VIX and the next attempt for VIX to rise above 30. So for now, that would be my guess. Sure, the 1 hour looks quite nice. I mean, I'm looking at the matrix now. You have VIX that is bullish trade, matrix that is attempting to rise. So sure, you could get an attempt above 20, but I don't think you will get the move above 30 right now. I would guess we will need another 2 to 3 weeks at least for this kind of move. Another asset that we talked about was US oil. So the buy signal that I got at the bottom right here proved to be correct. We talked about the sell signal 2 weeks ago that also proved to be correct, and the inability for the volatility of oil to remain at floor. So the condition to keep the long on for oil was the volatility of oil to stay at the bottom. It didn't. It started to rise, and obviously with the rise of volatility of oil, you got oil to go down. So for now, it's a no-brainer, not buying oil, and I would expect the volatility to keep rising and the price of oil to go down. So if you are short, I would say you can hold it for now. There is no issue. Vol is still very low. We are probably halfway there in terms of the vol of US oil. Another topic that was addressed in the several previous market talk was gold. So since gold went to bullish trend, every sell signal was negated. Every correction that we got was very small. So I got some sell and mega sell triggered these past weeks, but it's the same. It's for now unable to go down. So I know you guys are, some of you guys are either unloading their long or trying to short, but frankly, for now, I'm just not confident on the short gold. Platinum got the same kind of signal. See, mega sell, they usually work, but I mean, we are so far in terms of trade of vola for platinum. I mean, it has a lot of room to go down. So it's, I mean, in my opinion, it's not worth trying to short those. I'm trying to see if I have some interesting stuff to show, but yeah, basically,
How about nat gas?
Nat gas is ugly because you will get a lot of buy signal, you know, on the way down, because it's you can see here buy. It's disgusting to look at. It's because the moves are very extreme on this one. So in terms of trend, though, it's been unable to reclaim trend. So you can see here you had an attempt of a bounce, but the trend was unable to break, even though matrix daily is already almost exhausting. So no, I would not buy nat gas. I would not short it, but I would not buy it.
Thank you.
So overall, the sell signal worked on SPX, but I don't see this move continuing to test the lows that we had previously. I covered a lot today because I think we don't have what we need to get the continuation. One big hindrance was the Nasdaq basically going nowhere, despite the fact that you had the matrix exhausting the sell signal. This is a big red flag here, and the third, another red flag was indeed the VIX that I have addressed. I mean, daily wise, for volatility, we are not there yet. We still have some room. So I would not be surprised to see them try to squash VIX again. Maybe not this week, but next week. That would be my guess. So for now, I think I will wait. I will wait for correlation to move short term. So the 5-day ones. So I'm waiting basically for Bryan to give me the go ahead for this. And the other one I'm watching is the 1 year stock bond correlation, because those have been the trigger for the start of the bear market in November 21, the start of the chop, let's say the chop market that started in May of last year. And I have an idea of the trigger for the end of the chop and the start of the inflationary puke that I have addressed previously, and that was named by YH Alpha that we all know. But once it will trigger, I will say it publicly on Twitter, and then if I'm right, then I will explain exactly what happened. So yeah, that's pretty much what I'm looking at. I'm taking a step back and waiting to see if we can get a build up in short-term correlations.
So tomorrow we go up?
Yeah, I think we go nowhere. I think we go nowhere tomorrow, and then we start to go up. That would be my guess.
I'm joking. Yeah, very interesting. I also think that it's no matter how badly I want to short this, but after today, I'm still in waiting phase, except those puts. But I will talk about it before I start. My presentation will be very short because we covered almost everything here. What I watch for longer term swing trading. But first, I want to ask Bryan: you are still trading XLU IWM?
No, I was in it for the puke in February to March, and then it ripped up towards the top of the MFR long-term range, and I just got out at that time. Yeah, there was a good entry here pretty recently that I didn't take, and it looks like now the ranges are more favorable. But I don't know. I really I found like the way the spreads work for me, I really like to buy them when they just get super oversold and you have a big long-term upside downside ratio. Like that's what I did with XLU IWN. That's what I tried to do with IWN over QQQ. I just got out of that one today. It didn't work, and now it doesn't look favorable at all. And I've done it with some single stocks. I really like those, like just kind of catching a spread that's like really oversold and then just buy it and hold it until it rips. But no, not doing XLU IWN right now.
Yeah, and also I wanted to ask this in our chat, but I decided that maybe for others it will be more interested. But what about Nike JPM? It's very uncommon spread, and I want to hear your thoughts. What was the process for you to combining those?
Sure. Yeah. I put Nike over JP Morgan on yesterday. It was like a little personal trade. Yeah, it was like so
no, it's a very good idea. I just wanted to
go
inside your thinking.
Yeah, sure. So yesterday the market was selling, and I thought we were going to bounce yesterday, just like I think we're going to bounce today. So it was a little early on yesterday, but I want to express some kind of long perspective, but I'm not confident enough in really going long just to buy Nike, for example. So I want to be more neutral. And so Nike flagged on my signal on the long side as a potential, just a good buy. So I had like a good near-term signal strength on it, good long-term signal strength, and implied vol was good. It just looked good as a long, straight up. And so I was like, okay, like Nike's pretty good. And from a macro perspective, it's a good buy as well, or fundamental. And then I found JP Morgan, and JP Morgan got capped to the upside on the long-term range. And so had a 0% excess long-term upside. And so I was like, oh, like I kind of want to short JP Morgan, but I'm not confident enough in the market going down further just to short JP Morgan straight up. I was like, okay, so let me take Nike and I'll take JP Morgan. And then since I have both loaded into MFR, I plug them into the MFR range, and it recently went to neutral trend, which was positive. And I think it was showing higher highs as well. It has a pretty strong Hearst, and so it was green on the up move. And then if you look at it on Raphael's signal, I love plugging some of the spreads into his as well. The daily matrix is turning up. It just dropped extreme volatility, and it's about to go above his daily trade if we can go a little higher. So I threw it on.
I like it. I mean, that's why I asked, because it's a very interesting spread. Okay, yeah, so I will share my screen just to show some correlations. But first of all, why I still don't like what I see for shorting the market, that if we're looking at MFR, I was talking a lot that from a range perspective, I give most weight to upside downside ratio. And well, the only things that have a long I mean, in this watch list, and this watch list, I call it important to watch, doesn't matter, just some things I'm looking at at that moment, but the only things that have a long-term upside downside ratio, which is filtered now above 1, are the ones with a bearish trend, and basically yeah, even the things that are relatively oversold, I still don't see really good good signals, because when I like to go first from long-term upside downside ratio to a regular upside downside ratio, and the only thing that is promising, if we ignore trend, I don't ignore trend very often, but if we ignore trend, the only upside downside ratio which is above 1 in a regular range is TNX. So maybe it's a good sign that maybe the signal for bonds is not that far away. So maybe in upcoming days we will see something, but it's still not actionable. So I just wanted to say that, yeah, not a lot of bullish things with a lot of longer term upside. So that's one thing that is kind of positive for us waiting, but on the shorter term, well, on a shorter term, it's a very different situation, because I mean, SPY for tomorrow, well, in a few hours or so, it will change slightly, but if you refresh real-time range just after the close, it will be very close, because, yeah, we are waiting for some data to come in, but those changes will not be crucial, or sometimes it even doesn't change that much at all. But anyway, for tomorrow, those upside downside ratios are kind of, well, let's say not very bearish. But now what changed? So for those who saw my tweet, and I received a couple of questions, why you did that? It's not common to see you taking directional risk. So yeah, I bought some SPY puts based on MFR range, but yeah, so strikes based on MFR range. It was June quarterlies, but the reason was VIX and historical volatility of SPY. It doesn't matter which time frame I look. I mean, short term like 10-day, mid-term like 60, 30, 90, you name it. Volatility is both implied and realized are really low. Were really low, especially on that day when I bought those puts, and I believe it was the same day or almost the same day when Bryan did, also because VIX at those levels in this cycle, I thought, well, I will try, because puts are cheap, probability is not that low, so yeah, I wanted to play. But even after today, we see that, of course, correlations went up a little, but we're still nowhere near to risk off territory. I mean, big risk building territory is nowhere near. So we'll see, because 10-day average correlations are quite low. And Raphael was talking about stock bond correlation, which is very important for me. I mean, it also goes down, I mean, for the last 2 weeks. So it tried to go up, but we all know what happened, and it failed. SPY dollar correlation actually is very promising, because I like when the SPY UUP correlation is going down. That's what I want when I'm looking for reversal signals, because then I can look for reversal signals mostly in dollars, and I have 6E short, but yeah, I couldn't find a good opportunity to add to those shorts. Yesterday, I thought, oh, maybe after yesterday's short price action, that maybe today will be a good opportunity to add, but no. I have, when trading futures, I also add on continuous contracts what can be called a long-term volume profiles. So for those who know what volume profile is, so I just change those periods, so not daily or weekly, but for a long time, sometimes even for years, and to see where the important levels on continuous contracts are. And we are trading kind of at that level I was talking about, and 110.50, something like that. And I thought, okay, so maybe it's the time, but yeah, today it came back, so I have a very small position, but I wanted to add, but I didn't. So, and we'll see. So from correlation perspectives, yeah, we are still not there. Of course, longer periods are more lagging. So first I start with 5, 10 days and so on, but even on a 30-day basis, average correlation is very low. Changes 30-day correlations compared to 30-day correlations 5 days ago, almost all of them went down, except XLE and XLF. And about XLE, I was talking 2 weeks ago when I was answering the question about XLE IWM spread. So yeah, but overall correlations are falling still, even after today. Short term, of course, reacted. Longer term, not that much. Bonds, well, nothing to talk about that. I mean, for today, correlation is not very good for big collapse in market, the one collapse that we are all expecting. I mean, so stock bond correlations are not very positive for that view. For those who are waiting for a big collapse, I hope it's wrong. I hope we will get that collapse, but when I'm looking at one by one into signals I watch, at least stock bond correlation is not there. So yeah, I agree with a lot with those with all of you that said, oh yeah, I'm not very confident to short. I agree. I need at least a couple of more days to see what's going on, at least for now. Well, yeah, to sum up, correlations are still not going up sharply, especially stock bond correlation. Watch stock bond correlation in multiple time frames. For our cycle, which started in 2021 December or November, for that to continue, we need those to be positive, or at least to start going up. It can be an early signal, but yeah, we're still not there. So yeah, very sad to announce that 2 weeks have passed. We had really interesting days for those who are day trading or watching the markets, but yeah, 2 weeks have passed. But I just said the same thing I said 2 weeks ago. So I hope that after 2 weeks the situation will be totally different. But yeah, basically that's it from me. So. Raphael, do we have any questions on the stream, or I bet no, yeah?
No questions. We had to thank you from somebody called Ralph.
Thank you, Ralph, for
yeah.
joining. So
I have the data for Japan ready, or some charts.
Oh, awesome.
If you want to, so
actually I want to. Yeah, so I hope it will be useful for others too.
This is what I got from my market-based model, which looks at Japanese yen versus several other currencies, interest rates, several equity sectors. What's definitely true, these are the data regime probabilities. So what's definitely true is that economic output or economic growth is falling for Japan. So you can see stagflation, disinflation, they are dominating or have dominated the last months, and currently are still dominating to some degree. This is a daily regime probability, so it's can be much more volatile. For monthly regime probabilities, we're seeing that stagflation and disinflation are pretty much up to a high degree, but the model has some problems with capturing the level of inflation for Japan, so it's kind of tricky using rates and several commodities and some sectors, but it's pretty hard to predict and forecast, because if we look at Japan's CPI, it's down hard for February from January, from 4.38 to 3.27%. So on a 3-month trending basis, this would put us in disinflation, but markets are still not trading like it in Japan. What's clear is that leading indicator as a growth input, they are falling. So economic output is still down, especially in April for now. And this is the now cost with the latest data. So it's basically right around 0% year over year currently for Japan on these two estimation procedures. And here you can see some data for Japan. So we have industrial production, which is slightly up in February. Credit card business lending is up very hard in the last 2 months. Central bank balance sheets on let's say year-over-year first difference basis. So you take the year-over-year growth rates and then categorize them in first difference basis. So you just subtract them. Housing starts are down on the first difference basis in February. So it's kind of a mixed signal, which basically reflects the stock market behavior of the latest ones. What's kind of interesting is I don't have the time series on here, is consumer confidence, which prints at plus 16 on a first difference basis of the year-over-year number. So it's a pretty decent jump. I haven't looked into it to give a detailed explanation, but this is something to recognize. But consumer confidence always has a decent lag until it starts to get captured in the data. So this is basically some of the growth data for Japan. So you can look at it if you want to make a screenshot. So what else do I have? This is, I guess, Zoom added. So for my indicators, it's basically going nowhere. It's goes through my midpoint line, then corrects, always prints in a quantile 1 state, corrects then, and it prints back in quantile 5, goes in a zigzag motion. So you have at quantile 1, 10-month forward return at minus 3.4%, and in quantile 5, you have plus 4.4%. So it basically shows the anti-persistency, which my estimation for rolling bursts are also showing. So it's on the left side, it's 250-day, it's very low. 200-day, it's pretty low, and on a 100-day estimate, it's basically Brownian motion. The Shannon entropy is falling, which means it becomes more predictable. So this can be a bullish sign, or can be a more predictable sign for future price momentum. But this is not really presented currently in the data. So basically it's, I don't know, I wouldn't touch it for now, in my opinion. And also what I said earlier, this is for the S&P 500. The blue line, you can see the VIX, and the orange line, you can see the Leo-Puna exponent. So, and the model never touches anything with the VIX data, and it gives us a pretty good estimation for for the time series. It got the 2020 rise pretty, or nailed it, in my opinion. And I haven't looked really into the data, or did not, had the time to really get a good signal out of it. But maybe it shows if the sell-off is really trending or not, or if it was a head fake, in my opinion. Yeah, that's what I wanted to share.
Thank you. Yeah, it was very interesting and useful. Okay, so we had any bets 2 weeks ago, or
Yeah, we had a bet that everybody lost. Maybe not Ted, I'm not sure, but so the bet was will in the next 15 days will the short term 5-day rolling correlation stock bond will it have moved?
yeah, I remember that.
So basically it was I think it was negative, and all of us except Ted said it will be positive but not high, and Ted said no, very little change, and very little change. We are still negative, and actually going more negative today. So yeah, it's just crap. I mean, the correlations are crap. It's just to tell it very simply, it's just not moving in our direction. So yeah, the bet was that, and Ted won. So yeah, I don't know. Maybe you want to do a new one. Okay.
VIX level 2 weeks ago. No, yeah.
Okay.
So I don't know. The highest VIX will go till until another market talk, or the lowest or the highest, or I don't.
Okay, let's do this.
Because it's stupid to do bets, VIX level exactly on that day when we do market talk. No, just the highest or the lowest. Maybe the highest. I think the highest. Over the next 2 weeks, the highest VIX. Something like that.
Nobody wants to go first?
I'll go 22.
Oh. $23. Okay, I'm saying 23. I also don't want to say
Get
a
those
really
puts
high.
to pay. Get those puts to pay. Let's get us 23.
Yeah. No, I wanted to be 33, but I said 20.
Of course. Robby should be able to nail this one.
No, no, that's a tough one for sure. But I'll just throw out a big number. I'll throw out 30.
Nice. Okay, so Robby, 30.
It's a tough one because in 2 weeks it could actually be at the point where it's going up. So I'm going with 28.
Nice. So Ted and I are less
Wow.
more conservative. Yeah.
But you remember last time I said 40, and it's right after we got the big collapse.
Yeah.
What a bad call.
All right, I say 26, but definitely higher than now.
Okay. Bryan, did I miss you or?
No, I have no idea.
Yeah, it's
I have
I
no
got
idea.
no idea too. So what?
I'll say 20.5. But like,
wow.
I mean, like, I don't
Holy
think it's
shit.
going there
Like
right
any
now,
idea.
but I don't know. 20.5. How about that?
Okay.
Call.
Yeah, I actually have a question for Rob regarding what he posted for the how to say the move that we had for SPY versus the current liquidity situation. And I mean, if he had to go deeper into his thoughts, I mean, how do you consider it? I mean, because you said yes, something is going on. It's not. It's something else is going on behind that, because the move that we are getting intraday on the SPY are not reflective of the current liquidity situation. So what do you think about that, and what kind of trigger would actually accelerate the kind of volatility that we should see in the SPY?
Right. Okay. So I was thinking about it a bit more as we were talking, and I think the way I would typically characterize sector correlation, which is basically low correlation, what we have now, is a healthy state of the market. But given the illiquidity that I'm seeing internally, I think I would almost describe it as violent sector rotation. So even though it's protecting the indexes, it's not a healthy trade. Illiquidity in general is just, it's a characteristic of, poorly functioning markets. So the sector correlation is really masking that illiquidity.
So we could have a crazy move out of nowhere, just one day like this.
I think that's not unreasonable. I don't know like how much this illiquidity pushes the probability and the odds in that direction, but I do know that these tail events are, or tail data points are the ones that you want to kind of pay attention the most to, because it's just odd. It doesn't make sense.
Okay.
It's tomorrow, Raph.
It's what?
It's tomorrow. Tomorrow's the crazy move. You remember November? Remember that big move in November? Like 6% update in S&P?
Yeah, I remember.
Yeah.
That was also an illiquid day. It was
yeah, but vol was a lot higher at the time, was it not?
No.
And coming down, but it was in the 30s, right?
Let me see.
Coming down
Listen,
from
I
30.
think that day was
Just come off a tie.
It was November 10th. November 10th, VIX was at
It was higher.
26. It was
Yes,
well off of this high though. Well,
Yeah,
so
so it was coming down, right.
Yeah. I mean, that move like on that day from VIX, it went from 26 to 23. I mean, we could easily go 18 to 16 tomorrow. It'd be the same
Arguably,
thing.
we have an opposite condition that just took place last week with vol levels getting so low, realized and implied, and near market top, or at least interim top.
Yeah, how do you get a 6% move with VIX at 19? I mean, that would be insane.
Yeah.
Well, I mean, it's like what Robby just said. We should be getting higher moves. Because I mean, realized vol is so low. And so like actually, like if you got a move like that, you would actually start to realize what VIX is saying right now, and what implied vol is pricing, right? And like here, the big reason I'm saying this is because like they've stopped hedging the upside. Like, why aren't they hedging the upside tomorrow into GDP and claims and whatnot? Remember, like we'd always get these moves into like the CP, like when we were coming out of the BMR last time, and then we started getting the move up. They kept hedging the upside on every CPI print, every Fed meeting, this and that. They're underweight, and they started hedging the upside. Now they've stopped doing that, and so I don't know. It could happen. We'll see. And there wasn't like, I remember that day, like it wasn't a slam dunk, like clear. It was very similar correlation wise into that day as it is now. It's like, I think stock bond correlations were negative, sector correlations were low. We were toward the bottom of a range like this. No, the way they just bought puts today, I mean, you have the fuel for it to happen. So
Yesterday was ridiculous. I mean, nobody wanted to buy puts at 16.
Yeah.
And they started to chase at the right before the close. They started to chase puts, and I mean, people are so fucking stupid. I mean, sometimes you see them act, and you're like, oh my god. I mean, and did you see how the bulls were calling right before this? They were like, oh my god, we are so going to 42, maybe 4,300, and then the next day it got nuked. And now the bears are saying, "Oh my God, I'm gonna short, like
Throw it the hole. Yeah.
I mean, it's insane how price action will dictate positioning for some people. It's going up, they want to go long. It's going down, they want to short. I mean, it's like so yeah, let's see. But it's the data you dropped, Rob, is very interesting.
Very cool.
Wow.
I'm glad you guys found it valuable.
Yeah, I also liked Christopher, what you mixed with the 3 exponents to get the forward-looking price action. I mean, I saw you posted this kind of data in MFR also in the macro section, and it's you guys are great. I mean, you do a great job.
Thanks.
So yeah, we did the bet. We covered the question. I'm gonna have last look to see if some other people ask questions, and then we wrap it up. Yeah, nothing.
Yeah, very interesting talk. I really enjoyed it. Thanks everyone. I hope it was useful. And again, honestly, I hope that in 2 weeks when we do another market talk, correlations will be higher, volatility will be higher. And maybe we will not only get those sometimes just random spikes in the middle of a day, intraday, but maybe we will have some more serious moves that last. Yeah, so I hope it will come true. So yeah, thanks everyone. Thanks, Raphael, Bryan, Robby, Ted, Chris. Thanks everyone watching. If you have any questions, always feel free to comment on a video or on Twitter. Yeah, and hopefully see you in 2 weeks. Thanks. Bye.
You guys.
Thanks,
Please
guys.
share and
Bye, guys.
put a like
Thank
below the video. Talk to you in 2 weeks. Okay, it stopped. Yeah.